Today, we're going to dig into one of the most frustrating things in trading. That moment when you see the perfect breakout, jump in, and then it just snaps right back and stops you out. We're going to pull back the curtain and see what's really going on here.
So let's just start with this idea right here, because it's a big one. What if that breakout, the one you thought was the start of a huge new trend, was actually the very end of a different game being played by the market's biggest players? I mean, really think about that. It could totally change how you see the charts from now on.
All right, so here's our game plan for today. We'll start with that breakout illusion that gets so many people. Then we'll talk about what really fuels the market. After that, we'll map out the hunting grounds where this fuel is found, watch the liquidity grab in action, and finally piece it all together into a new way of seeing things. Okay, so first up, let's talk about a scenario that I'm sure is just painfully familiar. This is that classic trap that gets countless traders, and really understanding it is the absolute first step to avoiding it.
You know the drill. Everything looks perfect. You've got this super clear resistance level. The price smashes right through it. Maybe there's even a big spike in volume. So you hit buy, feeling pretty good, right? You think you've just caught a massive move. And then, poof, the momentum just vanishes, the price snaps back like a rubber band, and bam, you're stopped out.
So what is going on here? Why does this keep happening? Is it just bad luck? Are you just cursed? Or is there something else, something structural, making this pattern repeat over and over again? Well, the answer is it's not random at all. It's actually a feature, not a bug, of how the market really works.
See, to understand why these breakouts fail, we have to stop thinking like we normally do. We have to start thinking about what the biggest players, the institutions, actually need from the market. And trust me, their goal is probably not what you think it is.
And this slide, man, this just nails it. It shows the two completely different games being played. While we're all looking at our charts asking, hey, is that a head and shoulders? Is that a double top? A fund manager is worried about a totally different problem. They're thinking, how on earth do I sell $500 million worth of this thing without crashing the price? Their number one question isn't about patterns, it's about finding fuel.
And that fuel, that thing they're hunting for, it's called liquidity. Think about it. If you're a massive institution and you need to sell a huge position, you have to find a giant pool of willing buyers. If you need to buy, you need tons of sellers. Their entire world revolves around finding these big pools of orders. Okay, so if the name of the game is hunting liquidity, the next obvious question is, where do they go to find it? Where are all these dense pockets of orders hiding on the chart? And here's the crazy part. The answer is us. It's our own collective behavior. Because millions of us read the same books, watch the same videos, and learn the same strategies, we all end up doing the same things. We put our stop-loss orders and our breakout entry orders in the exact same super predictable spots. So all of our orders, bunched up together, create these things called stop clusters. They're these very predictable pools of liquidity, just concentrated zones of stop-losses and breakout entries. And to a big institution, these clusters on a chart might as well be a giant flashing neon sign that says, "Fuel here." And where are these hunting grounds? Well, they're exactly where you'd expect. Right above the recent highs, right below the recent lows, and you guessed it, all around those crystal clear support and resistance levels that everybody and their brother is watching. These places are absolute magnets. All right, now we get to the fun part, the actual move itself. The signature play that institutions use to tap into these pools of orders. It's a move so common that some traders actually call it the Jebakan Batman, or Batman's Trap. So, what is a liquidity grab? It's basically a purpose-built, engineered price move, and it has only one mission, to crash through one of those stop clusters and trigger all the orders sitting there. The goal isn't to start a new trend, it's just to get those orders activated so the institution can fill its own massive position. And the whole thing unfolds in a few really brutally efficient steps. First, they push the price right towards that juicy stop cluster. Second, the price breaks through, which triggers a flood of orders, people getting stopped out, breakout traders jumping in. Third, the institution on the other side just soaks it all up, absorbing that liquidity to fill their position. And then finally, once their order is full, the pressure is gone, and the price just snaps right back. Okay, so this is the million-dollar question, right? How in the world do we spot the difference between a real, legitimate breakout and one of these tricky liquidity grabs? Well, it all boils down to one simple, powerful concept: acceptance. Let's just break it down. A real valid breakout has follow-through. The momentum keeps going. The price actually accepts the new level. It builds a new home there. A liquidity grab, on the other hand, is the total opposite. It's a super quick spike and then an immediate sharp rejection. The price doesn't even think about staying at the new level. It just snaps right back. And that big volume spike you saw, it just disappears.
So, once you see this, it really changes everything. It forces you to make a fundamental shift in how you look at the market. You have to evolve from just being a simple pattern follower to becoming a more sophisticated liquidity reader.
And the solution here isn't to go find some magic new indicator. No way! It's about a total change in perspective. It's about stop seeing random charts and patterns and start seeing a structured game, a game of liquidity engineering.
You got to think of it like this quote says, "This is a game of chess, not a sprint. We are never going to be faster than their algorithms. Our edge isn't speed, our edge is patience. It's about understanding their game and then entering intelligently after the trap has already been sprung."
All right, let's wrap this up with the most important things to remember. First, start seeing those obvious clean levels as potential targets, not as your entry signals. Second, be patient. Wait for the price to prove itself. Wait for that evidence of acceptance before you jump in. And maybe most important of all, change the question you ask yourself. Instead of, "Is this a breakout?" ask, "Who is the liquidity here?" Because if you look at the chart and you realize the answer is me, it's probably time to stay away. And that really leaves you with one final question to ask yourself. Now that you've seen how the engine actually works, you have a choice. Are you going to keep being the fuel that makes the market run? Or are you going to learn to read its flow and ride in its wake instead? The choice is yours.